Hi, and welcome to today's video. We're going to be talking about the 3-bucket strategy for retirement planning. This is actually not a new strategy. It's been around since the mid-'80s, but it's really come into attention or into focus of late because the markets have been so volatile in the first half of 2022. This strategy tends to work well for people who are struggling or having some difficulty emotionally getting around volatile markets. So I'm going to dive deep into this, and I hope you enjoy it. Be sure to put your comments into the comment section. I'll be happy to get back to you as soon as possible. If you're new to the channel, my name is David Aaron of Aaron Wealth Management. I make videos on financial planning, retirement planning, estate planning, everything about growing your money, protecting your money. And I'm actually an active advisor working with clients right across Canada since 2001. I help people not only manage their money and their insurance, their group benefit plans for my business owner clients, but also I create their financial plans. So you'll find that it's a unique situation that I have with my clients. They don't have to go somewhere else to have their plans done. I do them for them. I do all the updates to their plan and get them a strategy that works best for them. Okay, so why don't we dive deep into this session. What I want to share with you is just sort of frame this the proper way for you. We are constantly in a crisis, or we're moving from one crisis to another. This slide isn't here to scare you at all, but it is a reminder that we tend to be having one big crisis, and then we have some time in between that and another crisis comes up. Think about 2008, the financial crisis. Think about the wars that are being fought. Think about COVID-19. We have these periods of time where it's pretty severe, it causes a great deal of stress, and then it gets quiet and another one appears. So if you don't think it's common, have a look at this slide here. This is sharing with you since 1928 everything that's been going on in the world, the wars, the economic crises, natural disasters, political, geographical events. You can see that it's not new, and the markets ran up anyway. And I'm going to share with you this one section. This is the last 2 decades, say from 2000 to 2020. Have a look at what happened just in that short period of time. We call this the lost decade, from 2000 till around the middle of 2000 and between 2010 and 2015, so a little bit more than a decade. But the lost decade really speaks to this idea that in 2000, when the dot-com bubble bursted, the markets went down, and then we had some other issues that happened. September 11 happened. Market began to run up, and we had the global financial crisis in 2008. The market dove down dramatically. It took about 5 years for the market to actually reach that previous high. So you think about that timeline, anyone that was investing in that was really having a difficult time trying to manage their money, and especially if you're getting close to retirement. So that's what I really want to share with you. Is it's not so much that there's volatility, it's the idea of when you need your money that's most important or most relevant. Here is similar chart sharing with you the same events that happened, but also highlighting the amount of time it took to recover from those events. You think the global financial crisis took over 1,000 days to recover from that. Here we are in COVID-19, and we're still going through recovery, even though the markets ran up to the high of December 31st, 2021, and then dramatically the market has sold off in the first half of 2022. We actually had a small recession in March of 2020, which only lasted a week. And why did it only last a week? Well, because the Federal Reserve in the United States and all the governments around the world decided to spend their way out of a recession. There's no way we're going to go into recession because of COVID-19. So here is the Federal Reserve and their balance sheet. A lot of money they printed in Canada, a lot of money. In fact, over 80% of the actual currency, US currency right now, is been printed in the last 2 years. Here's the 2022 first 6 months of the year. You can see like a light switch went off. The market reversed course and went straight down. Look at that, the NASDAQ down 20% for the year, and the S&P down 11%. The Dow Jones is about 10% negative, and Canada about 5.5% to the negative. Now, this is actually a slide of the S&P TSX, that's your Toronto stock market, and we're talking here about a period of, say, 2008 to 2022. If you were to put $100,000 in that market over the 15 years, you can see where there's areas here where the negative returns in the market over the 15 years. You can see how that 15-year period, 4 times throughout that period, your 100,000, you didn't have 100,000. You had less than $100,000. And I'm sharing this with you because this is relevant to the idea of market volatility and people who emotionally are finding it difficult to stay in the market. And so this strategy of the 3 bucket strategy starts to become relevant for people who are looking for an alternative to the market. Here is a typical emotional roller coaster ride. We would say people get excited in the beginning, the market's going up, you put your money in, you feel like it's going to go up and continue to go up. And then when the market turns, this is when all the anxiety, the fear, the depression, and the capitulation. I'm highlighting this word because you're going to hear this word in the news a lot. This is really a signal when you have capitulation. This is people basically saying, I give up, I can't fight this anymore, I'm not going to be in denial. Yes, the market is low, I get it. When that happens, it's usually an emotional signal that we're reaching the bottom of the market. And so you'll hear in the news, not that I want you to do all of your investing by just listening to the news, but it is a signal, because this is when people tend to believe that we're at the bottom, like it can't get any worse than this. Market timing. So what happens when people are in this emotional roller coaster ride? They decide to get in and out of the market. They'll sell their investments for cash and sit and wait for a better opportunity to get back into the market. Well, if you look at the S&P 500 from 2002 to 2021, if you had stayed fully invested despite the volatility, $10,000 investment would have turned into $61,000 and a 9.5% rate of return. In that period, if you had missed the 10 best trading days of the year, your portfolio drops to 5.33%. That's a significant loss, just missing the 10 best days. And it gets worse the more good days that you miss. If you look at this area here that I've highlighted in red, 7 of the best 10 days occurred within 2 weeks of the 10 worst days. And this one bullet point that you see, the second worst day of 2020, which was March 12th, was immediately followed by the second best day of the year. Now that's incredibly frustrating. Think of the person, if it might be you if you're watching this video, but you think of the person who is just emotionally spent. They can't stay in the market. They feel like, I'm just not going to watch my portfolio continue to go down. So they get out of the market, go to cash, and the next day the market has the second best day of the year. It's incredibly frustrating. It's like, the air being sucked out of your lungs. What are you supposed to be doing? And it's in times like this, people are looking for an alternative or some great sound advice to help them get through this period of time when we're going to have market volatility. So the 3 bucket strategy recommends creating 3 buckets. One is short term, one is intermediate, and the other is long term. This approach withstands short term dips. And I want to really just emphasize this. It's short term dips in the market. And I'm not talking, this 3-week period and then it's fine, and another 3. We're talking a period of time like now, 6 months or even a year. That's a short-term period for someone to actually have to weather that. And so this is what we're going to get into today. The whole point to the 3 bucket strategy is to avoid selling at a significant loss just to cover your lifestyle expenses. So think about, you're in this environment right now, 2022, the market is sold off, especially if you've been into US positions, and you need to have some money for your lifestyle expenses. So you sell some of your positions at a significant loss just to have the capital for your lifestyle. So this is what the 3 bucket strategy helps you to avoid doing. And so what I'm going to share with you is, when you do that type of strategy, when the market sells off and you need cash, so you sell perfectly great investments, The sequence of returns really matter here. Well, let's dig into this. You're in a retirement zone. If you are 5 years prior to retirement or in your first 5 years of retirement, you want to minimize significant losses in your portfolio. This is the highest area of concern for people who are in this retirement zone. So let's look at this sequence of returns. This is depositing a sum of money, and over a 10-year period, each one of these return streams received an annualized return, you see it in the red box on the right-hand side, of 4.8%. But the person who had 2 positive returns in their first 2 years of making withdrawals, so keep in mind this is someone who's making withdrawals out of their portfolio, same amount of money in each of these 3 scenarios. This person, you go all the way to the right, look what happens. They have $586,000 after 10 years and making withdrawals. The person who received a 4.8% every year, 4.8%, had $537,000. And the person who actually had 2 negative returns, two negative returns, one after the other, the first 2 years of their retirement or just of them taking money out of their portfolio, 10 years later had $100,000 less than the person who experienced 2 positive returns. So you think about that. The person on the green line burned through $100,000 more than the person who had 2 positive returns in their first 2 years of drawing money out. That's why the sequence of return matters. In all 3 of these return sequences, people didn't run out of money, but someone had $100,000 less than the other person just because of the sequence of returns. So that's why this really does matter for sequence of returns. Now, there are many retirement income strategies that you can choose from. So what I want you to just really focus on is don't worry about going after what someone else is doing. You have to take the type of strategy that works for you, the one that creates the most peace of mind and still hits your retirement goal. So don't worry about what other people are doing. You're going to be curious about it and do some research about it, but don't chase other people's ideas. Figure out which one works for you. So work with your advisor to get the right type of retirement strategy for you. So let's dig into visually, let's look at what the actual 3-bucket strategy looks like. On the bottom left-hand corner is your first bucket. When we say buckets, this could be accounts. It could be 3 different retirement accounts. It doesn't have to be a bucket. It's just a visual representation, okay? The first bucket contains all cash. You could have some GICs in there, but essentially you're not investing that money. Maybe a money market. The idea is 0 risk here. This bucket is used to pay for all of your lifestyle expenses. Lifestyle expenses means paying for your car, the gas, the groceries, even your vacations. Those are the types of expenses, the daily living. That's where that money is going to be used for. The second bucket in the middle is a conservative investment profile. So that means likely heavily weighted in bonds, maybe some real estate investment trusts, which would be the alternatives, and some equities, not a lot of equities. That bucket is really trying to produce a rate of return, say around 4%, that's just fighting inflation. Now, I know inflation is rather high right now, and we're probably going to have inflation somewhere between 3 and 4% for the next couple of years. That's okay. When we talk about your retirement, we're not talking about years, we're talking about decades here, right? So in this case, that middle bucket is really just trying to fight inflation and produce some rate of return that's going to be ahead of inflation. And then that money would be pushed every 1 or 2 years into the first bucket, because that first bucket contains enough cash to support your lifestyle expenses for 1 to 3 years. You have to decide how many years is relevant to you. You look at the economy, look at the markets, and say, and also your burn rate meaning how fast you go through your cash, and figure out how much capital you actually need. Is it 1 or 2 years or 3 years? If you're 3 years, it's because you're more risk adverse and you see more darkness in the market and the economy, and so you want to make sure that you're front loading all your expenses for the next 3 years. Now, that last bucket on the top right hand corner is really just the same as the second bucket, but more aggressive with equities. This is long-term returns. You're trying to get 8, 10% here. And so you're really trying to shoot for a higher rate of return that's not putting your portfolio or your retirement at risk, because it's a portion of your money. The main source of your retirement income is going to come from that middle bucket. And the third bucket is just helping to replenish that middle bucket over a longer period of time. So I want you to be clear about how that works, okay? Now, one of the things I want to say about the 3-bucket strategy is there is absolutely no evidence to suggest that this strategy produces a better rate of return than just rebalancing your portfolio every year. A blend of stocks and bonds has not suffered a negative return over any 5-year rolling period in the past 70 years. That's a powerful statistic for you to look at. And remember, this really goes back to the timing of when you need your money. If you're in that retirement zone, this is where you need to pay attention to your allocation. But if you're long with your money, such as in the third bucket this is where you can change your asset allocation to reflect a higher risk and a higher rate of return for your money. Now, phased retirement expenses. This is what people talk about, this go, slow go, and no go. During your first 12 years of retirement, you're going to likely have a higher expense because you're active, you're young, you want to go and experience life and do all these exciting things. That's what you're looking forward to in retirement. And then this middle part of your retirement, the next 10 years, is when your income will drop slightly because you're not as active, you're not going to be taking these as vacations as often as you used to. And then the later part, say you're probably going to be around 80 in the beginning phase of this, is where it's unlikely that you're going to want to go to other countries because it could be quite expensive for you to get sick in those countries. And mobility. Most people in their 80s struggle with mobility and their health. So this is where you're going to be spending less of your money traveling and staying close to home. Now, why I bring that slide up is because in this whole idea of people ask, how much money did you put into each one of those buckets? That's going to depend on how much you spend every year in your retirement. So think about a couple right now. They have $38,000 of CPP and old age security. Now that's taking the full amount, right? I'm not taking the average amount. You have to figure out what your actual CPP and old age security is. But you've got nearly $40,000 as a couple. And let's say you wanted $75,000 of annual income. Well, you're going to need another $36,000 of income coming into your home. Now, if you've got a pension, obviously that makes sense. There's your $36,000. If you have rental income or you're a business owner and you have money coming in that way, that's fine. But what if you don't have that? Then you have to save up enough money that's going to produce that amount, roughly $3,000 a month. And you want that to maintain the purchasing power of that $3,000 a month. So you want that amount to go up with inflation each year. So I'm going to use 2% in this example, not 4 and 6% the way it is right now. But you would need to have $750,000, this is the slide on the right, growing at about 6% rate of return with a 2% inflation rate that will produce for you about $3,000 a month going up with inflation. That'll go 25 years. That gives you some insight. And again, this video, I'm not having you to call me and dangle, a carrot in front of you. I'm giving you the information. This is all about your education here. So this is a good example of how much pool of money you would need to be able to have that $3,000 per month to get to that $75,000 mark. Now, what I always tell people is whenever you put money into an investment, you need to have goal behind it. I'm a goal-based planner. That means when clients come to me with their money, we talk about their goals. What are we doing with this money? When do you need this money? How much of the money do you need? Do you need it all right away, or do you need, piece by piece, month by month? Let's talk about what the goal is. So some of the goals might be a retirement goal. So how much money do you need to invest to have later on in your life, whether it's 60 or 65, whenever you retire, that's going to give you enough money to enjoy your retirement? Well, your income goals, some people say, look, we've looked at our retirement and here's what we'd like to do. and it's going to cost this amount of money, we need to have this amount of income. Or because it could be someone who's saying, look, we're also going into retirement with some higher expenses right now, so we need to have a higher income goal. Estate goals is really about maximizing your estate. You want to say, I want to push as much money as I can to my beneficiaries, my kids, my charities. I want to amplify this as much as possible and pay the least amount of tax. How do we go about doing that? Savings goals, people have savings goals, as you know. They want to buy a bigger house or more rental properties. Education savings goals, and then business goals. For business owner clients, you have many goals, one of which is how do you get money out of your company without paying any income tax. If you want to know, give me a call, I'll show you how to do that. But there's other goals. When you put your money in your company to invest, that's not part of your company's operation. That's a passive income tax rule. It's about 53% tax. It's hugely a detriment for you to manage your money inside of your corporation. So you'll be looking for other ways to invest your money without having to worry about passive income tax. These are all goals. They all have their own timelines. They all have different dollar amounts going through them. They have all different risk tolerances. So you can understand that just putting money into an account and not having a goal behind it, you really need to think more deeply and carefully about what your true goal is for that money. Now, how do you get to that? It's really about doing a financial plan. I say this in all my videos. A financial plan is seeing the outcome of your planning decisions before you commit to them. A financial plan is going to go through exactly how to do this. I have a great video. It's on the homepage of my YouTube. I think it's called Welcome to Aaron Wealth Management, that actually does a walkthrough of the financial planning, the award-winning financial planning software that I use to help people in 4 simple steps how we get very close to understanding how we're going to help you achieve your financial goals. I always end my sessions by telling you that we take care of your wealth management so you can take care of what's most important to you. I hope you got a lot out of this. If you like this content, please like and share it with everybody you think needs to see it. If you're not a subscriber, hit that subscriber button and that bell so you can get notified when I upload new videos. I hope you enjoyed this video, and I look forward to seeing you in the next one. Thanks very much, and take care.